Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. In this course, we will be discussing trading with technical indicators. Now, there is, of course, inherent risk when deciding to trade the financial market. So, as always, please do take a look at the following disclaimer to familiarize with the risks involved. Now, when we discuss trading with technical indicators, let's have a look at our webinar outline. The most important features we'll be discussing is leading and lagging indicators. Some indicators actually do provide preemptive signals to trading in financial markets, while others tend to lag the financial markets. We'll then be looking at placing technical indicators physically onto our MT4 trading platform. That will take the basis of moving averages, Bollinger Bands, and we'll be looking at the stochastic oscillator indeed. We'll be looking and defining momentum, average to range as an indicator, those moving averages both over different periods, Bollinger Bands themselves as a standard deviation from the mean, and then we'll be finishing off with a technical acknowledgement. When deciding to use technical indicators, we understand that they do serve a purpose. They can provide us with both a leading and a lagging indication for price movement, but aren't always the best and most concisive trading signals to effectively trade the financial markets. So first and foremost, we can ask the question, why do we decide to use technical indicators? Well, traders use leading indicators to predict future price movements. Ideally, leading indicators send you a signal to enter a trade before a new trend develops or an existing trend reverses, so you can ride the momentum for maximum profit. So when using these leading indicators, what we're looking to do is actually preempt a trade decision before price moves in such a way that we can have a very sound entry point and look to follow the momentum of the trade should a trade and a trend actually continue from that point. In reality, leading indicators can sometimes provide you with a false signal, and as a result, traders use lagging indicators and chart formations as well to help confirm the leading indicator signal before entering or exiting the trade position. Let's look at describing them both. A leading indicator gives a signal before the new trend or reversal occurs, and a lagging indicator gives a signal, of course, after the trend has started and is informing you the trend has started. With this diagram in front, we can actually look physically to see how a leading indicator, perhaps a wide range of various different indicators, could actually give you a preemptive strike on entering the market. Here we see with our blue line moving from left to right, we can see price. It has a very smooth price structure indeed, almost trading horizontally. Picture the leading indicator itself with the black line. It follows price over the period of the price journey, but actually as as the leading indicator moves up to actually to an inflection point, we can see that it is preemptive before the actual price structure decides to move in that direction. So what I'll do is actually use my Epic pen here, and we'll go for pink just to describe the actual preemptive movements of the leading indicators to try and give us a trading signal towards price movement. We can see there is a certain lag period after for the price to actually come into effect, where this price structure could follow the indicator itself. Leading indicators work especially well during periods of sideways market movement. This is due to the fact that many leading indicators are in fact oscillators, so they're looking to find momentum. So if we picture this physically when we're looking to trade the markets and we stumble across perhaps a horizontal market trading sideways and we're looking for a market to move in one direction, perhaps we can use a leading indicator to show us or identify when that is more likely to happen before the price itself moves. In a sideways market, however, lagging indicators are almost useless. Since the market has no clear direction, they can often provide random indications. None of these indications, however, can make for a valid prediction about future market prices. And that is simply because it shows us what has happened, what has actually occurred in the market, and gives us an overall smooth trend structure to the overall price action. Let's look at actually placing some of these technical indicators on our MT4 trading platform. So here we have cable, otherwise known as the pound US dollar daily chart price in front of us, and how we can actually look for trading opportunities is to use both some of these leading and lagging indicators. So first and foremost, let us introduce onto our trading platform the a trend indicator, otherwise known as the moving average indicator. What we'll do is firstly look for an overall smooth trend line to depict or show us how the trend is performing over a long period of time. We'll leave our sample at 100 and that will show us the trend structure over the last, at each indicative point, the last 100 trading periods, and we'll choose a dark blue for this sample indeed. So we can see that actually if we zoom out, we can see it's a very smooth trend line over a very long period of time. But when zooming in, it actually doesn't provide us with the most technical indication in terms of looking for trading opportunities. Then when we insert a moving average again, perhaps over smaller time frames, we'll look to insert a 20-day moving average period. Again, leave it with a simple moving average to reflect current values, and we'll choose an orange. We can see that the moving average is much more indicative in relation to how price is trading at the current level and in real time. And this is simply because when we choose to lower or decrease the level of time periods over indicator, it actually smooths out the sample from the previous 20 days each and every time. So in today's sample here, we will have our dot where the indicator is placed, representing today's candle. That will take form of perhaps the last 20 samples itself from here to here. So we can see that it's more reflective on it. The indicator itself is reacting to price in a much more shorter term, but again isn't showing us a real sign of how trend is performing over the long run in relation to the 100-day moving average. What we can do then is then insert the Bollinger Bands indicator onto the trading platform. And that's simply done by looking at the indicator up to the left hand side of the platform, insert indicator and Bollinger Bands. Again, we look to use a simple moving average to depict where we'd like to trade and what values are sufficient for us from a deviation from the mean. So the period indicator will in fact indicate a simple moving average. Again, we select a standard deviation of 2 deviations from the mean indicator itself and click OK. Now what that will show us as the market trades from left to right is a mean price following the price action and giving us a smooth price range. Then we can see 2 consecutive bands, both one above and one below, as price trades from left to right. The bands follow the price in such a method. What it would be technically significant is when price decides to actually break the standard deviation from a mean in a very vast and quick level. So here would be one example where we have a very what you would call a trading range, a thin contraction with the bands, and then we get a candlestick like this that greatly outweighs or breaks the standard deviation from the mean, and then we result in a very strong uptrend to the upside, a very strong bullish move there indeed. More resulting onto the most concurrent price action now, what would be significant for us, given that the mean is at this level here, we follow our simple moving average, that if this price were either to trade up, we would get a buy signal, or if it would to actually trade and break the standard deviation below the mean itself, that would constitute a very strong sell signal indeed. But in terms of following the overall structure, the mean as well shows us how volatile the price structure itself is in terms to the overall trend of the market. The final indicator we look to insert onto our trading platform is actually a momentum indicator, and it's called a stochastic oscillator. We see that we have a series of values up with the preference to actually trade in the markets. With daily time periods, we leave percentage K and percentage D at 5 and 3. Now, what that gives us is a price underlay, a technical underlay below the market. Here we have two very significant price levels in terms of technical support, or 80 and 20. And these are actually levels of support and resistance as the market trades from left to right. So what this actually is in terms of being an indicator of looking for momentum and looking for price movement, it shows momentum indicator comparing the closing price of a security or market to the range of its prices over a certain period of time. So due to the theory that as the market prices increase, it will tend to close, the market prices will tend to close at relative highs and look for possible buying opportunities. So we'll see in times where we see either a short-term trend forming or some more consistent price action, such as this channel here to the upside, we can see that the stochastic oscillator itself, showing that upward trend in momentum, actually verifies the trend, um, the the continuation for the trend from our price action candle itself. So it's just another indicator to show us how momentum is conforming to the structure of the trend, and we can use this with our Bollinger Band indicators as we see the price structure break above the standard deviation from the mean. So moving on to discuss technically what we mean by momentum. Well, as a central goal of a technical analyst, we are there to identify whether a price move is trending and with what forward momentum. A new trend is characterized by a burst of activity that can be seen in the Japanese candlesticks. A new uptrend starts with a series of higher highs and lower lows. When the candlesticks are large and you have several in a row, you may think you have an upside breakout and should possibly buy. Now, the ruling principle here is that momentum leads direction, so it is very much a leading indicator. A good example of this, as indicated, is the stochastic oscillator there. So how does this look like again on a price chart? Well, we have forward a bullish momentum here with a price increase to the upside. Now, what we can see with the more general momentum indicator over a 14-day period is that we see that momentum tends to increase as we get these price increases, or consistent price increases, is more relative to a strengthening momentum indicator. Now, it's not always the case, and I'll outline that in just some detail here. We have the momentum 14-day indicator that signifies to us that every point on the indicator is notified by the previous 14 days or 2 weeks of trading, and we see this bullish price action here to the upside. What is significant actually is as this long-term trend continues to trade to the upside, we see that we get a more general increase in the indicator itself above higher nominal levels, and that would indicate that over this period of time we do see an increase in momentum and most likely a trading participation volume in the market itself. So that would indicate that who is control of the markets? Well, in this case, we certainly have the bulls pushing price up, and the price is being pushed up with certain momentum indeed. When discussing average true range, we refer to the high to low range of the Japanese candlestick of any time frame whatsoever. It is described as true to account for the full movement of price, even when the market experiences gaps, and the markets can often gap. Now, this mostly occurs in assets like Forex. We do know that they trade nearly 24 hours per day, but we get daily gaps mostly on Sundays when the Asia market is the first session to open after Friday's New York close. Although we can often see them in many different assets where we see price shocks to the market as well. So to give you an idea, if we have a company like Microsoft that gets very strong corporate earnings, perhaps from Monday to Tuesday, overnight that stock may open up quite so many ticks or pips and be reflective in the true range of the overall price movement or average true range. When considering the average true range as an indicator, it is important to view the price action as it reacts to increasing or decreasing price range. So here we have an example here, and what is quite significant within these 2 points is that they actually contradict each other. So we can see that technical indicators, they certainly do provide us with evidence, but they're not always significant in terms of their consistency. Here on the left hand side, we have more price uncertainty, and this is viewed by the Japanese candlestick structure themselves. We can see they're much more volatile. We can see a very full-bodied bearish candle indeed, almost engulfing the price range from previous candlesticks. So a very large move in the market, and that has actually coincided with a bit of an uptick, a strong uptick in our ATR average true range indicator. That would indicate that there's more volume, there's more volatility in the market when we're seeing this price structure here on the left hand side. Then what is significant, as the market starts to trade up, you might think we're starting to get some shift away, and wondering, is there momentum or is there perhaps volatility in this trade position? Well, we do see the consistent move to the upside. However, again, volatility is actually decreasing in this period again. And as we see, as we move forward across the chart, a period of consolidation and then a very strong, consistent up move in this price action again between the channel. It is a bullish channel, but we see lower ATR signifying, as the market moves up, we can see actually a decrease in the ATR indicator, signifying potentially low volatility with a very low trading range indeed. Looking at moving averages, they are effectively lagging indicators. So this means that they are based on events that they have already occurred in the market, as opposed to predicting indicators used to form an opinion on future price speculation. Traders can choose to use either a simple moving average, a weighted, or an exponential moving average, and they all have different relations in terms of smoothing over the average price indicator itself. While moving averages do lag behind the spot rate, their real contribution is helping to determine the strength of the current market trend and to distinguish true market reversals from typical exchange rate fluctuations. And that's why we often use them. We know that the forex markets are very volatile. We know that we can see a lot of false breakouts. So we look to smooth over the entire average trend, so that when we do get a very technical setup, perhaps when price um, comes to conform to the long-term moving average, or perhaps breaks that level, and we can look for potential trading opportunities. So here in front we have the Euro US dollar, and this is daily price action. What we can see are three very different long-term moving average indicators here. What we have first and foremost is a 100-day moving average, and that is indicative of the price range itself. What does that mean in terms of the indicator? Well, we can see that it is a much more smoother trend over the long term, and that's because at each interval, or each point that the indicator marks a present point, it actually smooths the average range over the last 100 variables, or price points. So that would perhaps be within this range. As I mark each 100 days, each point will look to smooth the range over that time period. Again, it's not the best indicator to actually look for those shorter term opportunities, given that it is looked as really smoothing the long term trend of the market in question. What would be more concurrent to actually looking for shorter trading opportunities would be perhaps a 50-day moving average. It does the same, but obviously looks to divide these in half with 50 days for each trading time period. So effectively, the moving average indicator itself will conform to more volatility, more concurrent or recent volatility, and actually look to be a more volatile, smooth moving average indicator. Again, the 20-day moving average indicator will be much more volatile and will reflect the most recent price change within the indicator itself. So if we're looking for potential short trading opportunities when the market comes back to actually break or increase above, given this is a bullish trend, increase above the indicator, we can look for those shorter trading opportunities with much more um, efficacy with the shorter day moving average. But again, the point of the moving average indicators is to show the overall trend structure over the long term, and they're technically significant when prices trade across longer smoothing averages than the shorter simple moving averages. Moving on to Bollinger Bands, we know that they're placed over a price chart and consist of a moving average together with the upper and lower bands. They are based on a statistical standard deviation from the mean. Now, what does that mean? Well, the area between the moving average line and each band produces a range or a channel. Bollinger Bands show relative volatility changes through the width of the bands themselves. The wider the bands, the greater the volatility, and obviously the thinner the bands, that's indicative of much more less volatility within the markets. So here we have Bollinger Bands here following cable, or otherwise known as the pound US dollar. We have a daily price chart, and we can see the bands widen and contract with the volatility after the fact. So after the fact means that this is most certainly a lagging indicator. We can see if we look at any real consistent price movement, perhaps this very strong price structure to the middle, we can see an upward trend. We can see that the indicator really provides us with no consistent proof to actually try and capture that trend. It actually lags the trend and doesn't start to move until the trend has broken out. Then when the price action actually looks to reverse, we can see the indicator takes its time to conform to the price action and actually lags the pricing structure indeed. In terms of looking for actual opportunities, we know that what it does indicate is increasing or decreasing levels of volatility. And if we refer to the main band as our actual simple moving average following the market, we know that as these widen and contract, volatility or a larger or increasing standard deviation from the mean can provide potential trading opportunities. So here's one example where we see volatility start to decrease, i.e. the Bollinger Bands will start to actually contract within our price action, and then we get a possible breakout to the upside as the market opens here. Just and I'll use a different color pen just to annotate this. We can see the market open just almost at the mean here. It trades up and actually closes and touches or closes above our Bollinger Band, so that would indicate that it's actually traded +2 standard deviations of the mean with this indicator, and that there's a potential trading opportunity to the upside. And just to finish our discussion on trading with technical indicators, we can make a very firm and distinct acknowledgement as technical traders. This distinction is, well, between leading and lagging indicators. It's not a terribly useful one, as long as you acknowledge that momentum will often lead and moving averages will always lag. So we have leading and lagging indicators, and we must know the difference. You can never make a moving average a leading indicator, but the so-called leading indicators will generate a fair number of false or wrong signals. So we do need to know the difference between these leading and lagging indicators, perhaps use them both at the same time whilst reading the price section to look for a more consistent, concise technical trading opportunities. And to conclude with our webinar outline, we discussed the technical indicators, leading versus lagging, and what they mean for our trading. We looked at momentum and how volatility can be actually deciphered by the average true range indicator. We looked at moving averages and how to input and observe them over different time periods, and obviously looked at Bollinger Bands and how they can outline the amount of volatility and potential trading opportunities when this volatility laxes or looks to break out in a certain direction. Thank you very much for joining us on this installment of Courses on Demand brought to you by Forex Academy. We do hope to see you very soon. Bye for now.